Some voices there reacting to the better-than-expected U.S. jobs print. Joining us now for some more insight on those numbers is Caravel Concepts Chairman and CEO Michael Jones. Michael, thanks so much for joining us. Now, that pickup in U.S. payrolls, that could complicate stimulus negotiations. This amid worries of a K-shaped economy. On Friday, Larry Kudlow pointing to the possibility of a scaling back of relief. This as Fed Chair Jay Powell cautioned that the U.S. recovery could slow from here. More volatility for stocks ahead, given that stimulus is in question?
Well, I think that the reason why the stimulus is so important for stocks has less to do with the economic recovery and more to do with getting the Fed off the sidelines and printing more money to inject into financial markets. There is no question that the fact that the recovery is running a little bit ahead of schedule is making the negotiations between Congress and the president more complicated. The negotiations between the House number of $3 trillion and the Senate of $1 trillion. This could drag on through the election, but ultimately, you mentioned K-shaped recovery. And the jobs that are coming back are the jobs that are easy to restore in a socially distanced economy. The jobs that are not easily restored in a socially distanced economy, those people are still suffering. They're still struggling. We've got about 1/3 of renters looking at potential eviction without another COVID stimulus package and the money for landlords. Those people are going to be out on the street. So there will be another stimulus package. It's just a matter of when. And when the stimulus package happens, the Fed will support it with more money printing, in our opinion, irrespective of where the unemployment rate is.
In that anticipation, if we do get another round of speculative buying, where are you seeing the winners?
Well, I think that you probably first we probably need to think of this in two phases. Because the complications in the negotiations in Washington could drag this out through the election, we need to kind of buckle our chin straps and recognize that with the Fed having hit the pause button on the money printing machine, we're now able to have pullbacks, and we should expect more volatility than we've had in the last 3 or 4 months. But once they get back in the game, once they come off the sideline and they hit the print button again, in my opinion, the winners of this next phase in the bull market will shift. If we think about the bubble that we saw in 99-2000, after you had the pullback, after you had some of the real speculative things blow up, there was another leg up in the market, but the super high flyers trading at 100, 200, 300 times earnings, they weren't the leaders in that next leg. It was the quote-unquote conservative names trading at 30, 35 times. So we think that we'll see a flow back into big tech, but it's going to be the big tech leaders. It's going to be less, the Teslas of the world and more the Googles and the Apples. We also are really high on the home building.
Sorry to jump in, Michael, but I think what you're saying is that if we see more of a sustained pullback, that's actually a healthy thing for the market in the longer or at least the medium term, right? That in order to add the sense of breadth to the market that we've been waiting for.
I think every market is benefited from a pullback, going 2 steps forward, 1 step back. I think that the kind of speculative option trades that blew up on Thursday and Friday, I think that's a very healthy thing to clean that kind of speculation out of the market. So, yes, I absolutely agree with that. I also think that a market that is being led on, real speculative expectations of earnings growth and the companies that, that are trading at just unsustainable valuations, that's also risky. I think that getting a pullback where some of that real froth is taken out of the market, reestablish a nice base, and then come back with more fundamentally driven things like big tech and housing, and frankly, the commodity-centric emerging markets. We've had a huge rally in commodities like copper and gold and iron ore, and the countries that produce those commodities have not participated.
So if you look at price to earnings, which I know you say you would be buying in a pullback any of the dominant big tech that's trading at less than 35 times, but if you look at free cash flow yield, for example, do any of those companies look appealing?
Yeah, I think we have to look at things through a bubble lens, and we have to take the long-term discipline and the averages out of the equation. We need to recognize we're dealing in a world where corporate bonds are trading at 2%, 10-year treasuries are in the 60 basis points, and if we look and compare this to the last bubble we saw in 98, 99. You can get PEs on big cap tech names into the 50s and even the 60s. And frankly, I think the conditions are probably going to be in place to see that happen again. And so even though my value-based instincts flinch every time I say it, 35 times earnings is probably going to look pretty cheap a year from now.
Michael, this morning we are seeing U.S. futures move to the downside. NASDAQ futures earlier falling as much as 2%. Volatility in the name of the game here, and we're seeing that rise ahead of the U.S. election. How are you positioning given the heightened risk of more price swings?
Well, I will not be confident in putting more money to work until there's a COVID-19 stimulus package and the Fed has hit the print button again. I do think that we went 6 months in a straight line, straight up. We need a pullback. Thursday and Friday probably weren't sufficient to really clean out the speculative excesses. I think we're going to have a nice, healthy pullback. That will probably, in all likelihood, be the catalyst to get the president very serious. He doesn't want a big market correction in the run-up to the election. That's what's going to probably put him to prod the Senate to make a deal with the House, and we get something before the election. Until that happens, I think we're going to have to deal with volatility, and the buy signal will be when you see a deal signed in Washington for new COVID-19 stimulus.
Michael, do you still buy into the story of stock market exceptionalism in the US when the dollar is so weak and you've got all these opportunities across emerging markets as a result of that?
I think both emerging markets and Europe look very, very interesting. I mentioned earlier that emerging markets have not really participated in the rally in commodities. And look, this is where, South Africa is where gold is mined. Copper comes from Chile. So the opportunities for those markets to do much better as they catch up with the rally that has happened in the underlying commodities, I think is very powerful. I also think that Europe, they haven't even begun to really stimulate their economies, and yet they pretty much so kept pace with the recovery in the U.S. If you just look at their PMI surveys. There are some exceptions like Spain that have had a second spike in COVID, but for the most part, they're having a nice recovery too before they've really hit their economies with the $2 trillion stimulus package that's coming early in 2021. So I think both Europe and emerging markets look interesting. And, Warren Buffett isn't buying in Japan for nothing. The cash positions of Japanese companies give them huge opportunity for stock buybacks and other shareholder valuation strategies. And I think you could see good things happening there as well.
All right, Michael Jones, always appreciate your time with us. Caravel Concepts Chairman and CEO joining us.